Hello and welcome in, everybody. My name is Miles Clark. I'm joined here by good friend and colleague Joseph. Joseph, we are recording the podcast on April 22nd, 2026. This will be coming out on April 23rd, 2026. How you doing?
I'm doing good. I mean, markets have been continuing to grind higher.
Before we talk about markets, we have to talk about the most important thing for you and I. The NFL draft is coming. You're a Jets fan. I think it's your year. What do you think?
I mean, I don't think it's our year anytime anymore. I
What do
mean,
you got? Geno Smith back there? Is he
yeah,
back?
man, it's going from Justin Fields to Geno Smith. I mean, a lot of optimism.
There's a lot of good stuff. And what, you got the second overall pick? That's something to beat, right? Is it
Yeah,
second or third?
second,
Okay.
second.
You got the second overall pick. Maybe it's time, you'll come around. Brees Hall's still there. Garrett Wilson. You got a great team. You have my guy, Demario Davis, coming home. I'm a Saints fan. We're just as pessimistic, I suppose, although we might not have as much reason to be.
Yeah,
But we'll see, obviously, that we are not a football podcast, but we probably could be one. We are a markets podcast.
yeah.
Now, talk about maybe the unrealistic hopes of the Jets winning the Super Bowl, unrealistic hopes of the markets hitting all-time highs coming off of these recent lows. I know you and Ian talked about it a lot last week, but we've just seen more of a continuation of that same thing over the last week, right?
Yeah, I mean, really nothing's changed dramatically. We've continued to push higher. Um, Ceasefire talks got extended yesterday, so that made the market feel a bit better. So we're just sitting around all-time highs right now. Um, as of today. We'll see if things change. I mean, oil has still been pretty volatile, but not getting back up to levels well above 100 like we had seen the last couple of weeks.
Right.
So we'll see. We're in the midst of earnings season as well.
Right.
I haven't seen anything that's like too troubling on the earnings front yet. But we do have some big earnings next week in terms of a lot of the Mag 7 stocks report next week.
Right. The first one we were looking at, or the first Magnificent Seven one that will come to mind is going to be Tesla. They're reporting after close on today, so we figured we wouldn't talk about it, at least as a featured chart, if you will. But they're the first one that really gets us rolling, no pun intended. And then you get into the Googles, the Metas, those guys, and then we wrap up with Nvidia towards the end. So certainly going to be a lot to watch going forward. I was going to say something about the overall performance. It's just been, positive, as you alluded to. Oh yeah, in terms of the biggest gainers, Nasdaq Composite, Russell 2000, the equal weighted index over the last week, all up over 1.5%. Towards the downside, your commodity focused areas, crude, gold, and then international markets with EFA down around 2% as well. So just some context for the last week. But one of those bigger gainers was small caps, right? The Russell 2000, IWM as a proxy for it. Let's go ahead and take a look here. I'm going to share my screen, pull up IWM. That chart, Joseph, looks pretty good.
Yeah, I mean, never gave a sell signal, despite pulling back in March with the market volatility. 4.36 fund score for IWM, up over 11% this year. Compared to large caps, looks really strong. Now, I will say, I think getting away from cap weight right now, based on our longer term rankings, maybe a bit premature. But you can't really deny that small caps, and even from an equal weight large cap standpoint, like the S&P equal weight index, which has done pretty well this year, um, all that looks really strong and good breadth for the broad market, which is what you want to see.
Right. Yeah, and we'll talk about some participation stuff a little bit later too, but that's obviously moved higher. I do just want to point out some admittedly cherry picked looking triangle patterns on this chart for IWM. You'll notice there at the very beginning of 2025, that won't flag as a bearish triangle, but that kind of sell signal there in what was that, March, right there where my mouse is over, that kind of was a formation of a triangle quasi, and obviously the big one coming back there in last summer or so, coming off of those 2025 lows. You had a big consolidation pattern come into that point there, and at that point, right, when we talk about pattern consistency, you find that area, you're finding demand, buyers coming online, break that bullish triangle pattern there, and then break subsequently to new all-time highs for small caps throughout the close of 2025 and the 2026. So that's just a bit of a technical jargon, but like you said, I mean, small caps have done quite well. There's a lot of individual sectors that are doing quite well on the small caps front. I just covered industrials, so PSCI. That's the kind of industrial small cap representative. So as we're moving further into Q2 here, there are a lot of areas that are starting to look quite good again, right?
Yeah.
And as we talk about other areas, right, like the equal weighted assets with SPX EWI, right? We can, I guess, move over to participation. Do you want, or
Yeah.
do you
Yeah.
have
Yeah.
do you have anything more on small caps?
No, not in particular. I think it's kind of like wait and see mode for small caps, at least in terms of getting rid of my large cap weighted exposure,
Right.
type of deal. Even international, I would still kind of prefer over U.S. small caps right now, but good story. And again, even if you don't own this like small caps or have an overweight towards them or anything like that, it's good to see them doing well. It just broadens out the market. In terms of the S&P 500 for large caps, we saw that PTSPX got all the way down to 50 and now it's back in excess. So we never dropped below 50. So in our very basic own, own the S&P if PTSPX is above 50% and sit in cash if it's below 50%, you would have never moved the cash, following kind of like that simple strategy. But nonetheless, good to see. We do see like kind of declining still here on the PTSPX series of lower highs here. Would like to see that get back above 70%, which is usually where you see these really strong markets that last for quite some time.
Yeah, I'd agree with you, right? Like first on your point of, holding 50, just from a conversational point, half of the S&P 500 trading in a long-term positive trend,
Mhm.
that sounds like a good thing, and it is a good thing, right? When you look at the historical returns. I do see your point, and I'll raise you one. What is a bit tumultuous, is that the right word? Tumultuous?
Tumultuous.
Oh, there you go. We're learning something new. I'm a stock guy, not a vocab or a vocab guy. All that to say, right, what has been a decline in participation coming off of those 2024 lows. I also want to mention we did not see, although it was an extremely volatile time to start 2026, we did not see us test levels from the April tariff tantrum. We did not see or experience levels that we saw throughout the majority of 2022, which we know now was an extremely bad year. So, although we have declined in terms of our long term participation rate, I do want to at least emphasize that what we know to have been poor market conditions, we didn't get there in 2026.
Yeah, and functionally, this has been a relatively normal pullback. Remove the geopolitics, the news headlines, just from a purely kind of mechanical standpoint. I mean, you expect kind of these roughly 10% pullbacks to happen once every year or so, 18 months, I think it is, a
Right.
year to 18 months. Um, so and long term, the market has still looked pretty good. I mean, but domestic equities did fall in our dollar rankings briefly, but like on the asset class group scores, the S&P 500 Index Funds Group was still kind of the top ranked out of our major asset classes that entire time, as well.
Yeah, and I think what's interesting about, kind of how things feel, right? Markets are moving extremely quickly nowadays, right?
Yeah,
So it feels more severe. It's occurring over the course of 1 week, right? And then you are essentially ripping back higher over the course of the next week.
yeah,
And so it definitely feels like there's a lot of movement, but all in all, like you said, markets can't go up every single day. We wouldn't want them to go up every single day because we need as trend followers, we want a dispersion between winners and losers, right? And so markets moving around allows us to take advantage of that dispersion.
exactly. Yeah, and then one thing you mentioned something that's pertinent. I'm sure a lot of advisors have felt this over the last few years is that it does seem like we're getting these violent pullbacks more and more often, and then it just kind of a rip back to rip back higher. And I think we could have a couple podcast discussions on maybe
Right.
why that is, but one thing, the market is more concentrated than it really has been in a long time. Um, so if a handful of stocks aren't doing well, there's really not much the market can do to fight that. You know what I
Right.
mean? Um, Second is, well, maybe why it's getting more concentrated and whatnot. Obviously, those stocks are performing better and better, but the reason for that outperformance um, doesn't necessarily matter to us, but more buyers than sellers, right? But with the level of concentration that we have in the market, it's not too surprising that we see these more violent pullbacks and then vicious rallies back up. But generally speaking, when we look at the long term picture, it's 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 positive.
Right.
So you kind of got to hold through some of those volatile periods as long as the longer term indicators are positive.
On your side.
Yeah.
You track it, and this is an aside. You track it a little bit more frequently than I do. Has concentration dropped off a little bit? I feel like conversationally it has, but I'm sure it's still, at least historical averages, I'm sure it's still elevated, right? But I remember, 2024, 2025, we were extremely concentrated. Do you know off the top
It's
of your
it's
head?
roughly the same.
Probably the same. Okay.
I wouldn't say it's changed too much. Obviously, anytime the equal weight's outperforming the cap weight, usually that means it's the cap weight's getting
Right.
slightly less concentrated. But we haven't seen it where the equal weight's outperform the cap weight on a 3-year basis, or
Right.
anything like that. So it's probably still roughly around 40%,
Okay.
and 10 stocks, 5 or 10 stocks. So no, not too many changes there to
Okay.
start the year.
Well, that's fine. Another area, talk about consolidation. Another area that has consolidated a little bit has been gold
Yeah.
and precious metals. Now, what was a previous high flyer to open 2026, and really for better reason of 2024 and 2025, just incredible rates of return for gold and silver. And then you kind of had a blow off top moment to open up 2026. And then it was funny. We're sitting around the office and like, you've already had a 70% gain for silver. And then you saw it essentially get halved.
Yeah.
And then you're like, oh, well, we're up 8% for the year. So it's like, oh, well, what ended up happening? But obviously lots of movement for silver, lots of movement for gold, and a notable landmark for GLD as a gold representative. You were writing something about that in the report today.
Yeah, so fund score fell below 3. That's one thing. That's the first time it's been below 3 since late 2022. Um, Also gave a sell signal on its RS chart versus the S&P equal weight, first one since 2024. And then also if we're just looking at the chart um, itself, it's kind of like found this support at 400 and then resistance around 450 so far. So interesting to see how this plays out. It's still up 8% this year, you know. Um, and if people have been following this for the last few years, they've probably held on to it roughly that entire time. It's been a fun score above 3 and have some pretty big gains in it,
Right.
right? Um, Now it is off about 13% from its high from earlier this year. This is one of those scenarios where the fun scores, yeah, you generally want to use them as a guide, right? Like if it's below 3, you want to probably look to get rid of it or avoid or sell some exposure. However, with GLD, it's still up 8%. It's still holding that 400 level, which I think is, with that recent test and active support, is probably going to be your line in the sand
Right.
from just like a price level standpoint for longer term holders here, just to protect any gains that you have. So I could be convinced to continue to hold on to this one despite the fund score dropping below 3, and the RSL signal.
Yeah. So there's first off, excellent points from you there. While you were talking, I want to at least just mention to people while we're sharing screen here. If you want to look at the fund score over time, pretty cool thing you can do on the platform, fund score or TA score. You can click on that where it says fund score in the top left, and it'll bring up like a history of the fund score. So check that out. But to further the conversation on the current situation, I think the point here is that the fund score might have told you one thing, but looking at the chart, this is where some of the art comes in, right? I don't think this has given you quite yet a definitive reason to sell and go realize a whole bunch of gains that you undoubtedly have on this, right? In a lot of your client accounts. So, like you said, and I won't try to say it better than you, but that 400 mark for GLD seems incredibly significant. And then obviously, if we're waiting to see some near term or some relative strength enter into the space, your landmark is going to be around the top of the trading band and those all time highs, and then that resistance level just below there around 40, 490.
Yeah.
But right now, right smack dab in the middle of the trading band, I just don't see a reason that we need to to get out. Maybe we stop adding, right?
Yeah.
But
Maybe we're
there's
not
some
as
middle ground.
aggressive with our
Yeah,
exposure.
yeah,
Maybe on this recent bounce, like if you're like, okay, we haven't rebalanced our gold exposure in 3 years because it was doing so well. Maybe now is a time where you rebalance or something like that. But if it's just if it's in your portfolio and you're like, well, I still feel pretty good about it. I mean, I wouldn't, fault anyone for saying that. In fact, if I own this, if I had like a really big outsized position in it, then yeah, I'd probably take the time to trim it at this point.
right.
But am I selling this right here? I'd probably say no. I'd probably give it some, give it some room, right? Just give it, like you said, the performance over the last few years has been so strong. And it's been volatile to the upside. It hasn't really been volatile to the downside over the last few years. This is kind of the first volatile event that we've had um, in a while for gold, and it held up relatively well compared to historical levels, and it's still up about 8% this year.
Yeah, just for fun, just pulling the eye test. The last time we saw, we had a like that big column of O's down at the beginning of March or mid March. But besides that, that was 16 O's. Besides that, you had one coming off the top at the beginning of 2026. And then really besides that, you hadn't got like an extended column of O's lower going back until 2022.
Yeah,
At least in one fell swoop. So
yeah,
when we talk about upside or downside volatility, so it's been a lot of upside, not that much downside, and like you said, now sitting firmly in 2026, it's an area to watch, maybe an area to be less aggressive on, but not necessarily an area that we want to cut exposure.
mhm,
Okay, last thing for today, talking about finding strong sectors, what to do with sectors that look like they're rolling over but are still relatively strong comparatively to other areas. And what we do to kind of quantify this is Dorsey Wright utilizes what we call a matrix based system. Now, we talk a lot about relative strength, comparing one asset to another asset. But if you wanted to look at a whole bunch of assets all against each other, it would take quite a long time to pull up every single calculation on its own. Luckily, Dorsey Wright has the Matrix system, which is not just a fun movie. It is a system that we calculate or compute a whole bunch of relative strength tests at once. And so here on the screen, I'm navigating over to our whole list of pre-made matrices. We're today going to focus on what we call the NDW group matrix, but there's a whole host of available matrices available to you on the platform. What's special about the group matrix is it takes 40 different sectors as well as the broad market, and then it simply compares them against each other in a big arm wrestling contest. So, in layman's terms, those groups that are at the top, they're our strongest areas. Those groups that are at the bottom are our weakest areas. All of the colorful stuff you see over on the right side of the page, those are all individual relative strength tests. So you can click on any one of them and see the computation in more detail. But for the sake of today's conversation, we want to focus on the top versus the bottom and how to read the top versus top versus the bottom. So just to name the top five or six or so, Joseph, we have semiconductors, metals, electronics, telephone, oil services, biomeds, and then oil again, and then transports, non-air. This is more than five, but you get the kind of idea, right? Semis are towards the top. What we want to talk about today is a little bit more on the energy front. Those guys are towards the top. They're in the top 10 of 40, but their near-term strength has dissipated a little bit. What do you, as someone who's reading this matrix, what do you see when you see that?
Yeah, I mean, typically when we look at the matrix, we're looking at that buy signal column, so a longer term indication of relative strength, right? Now the X column is going to give you a more of an indication on near term relative strength, right? We're
Right.
looking at the column of that relative strength chart. Um, for example, if you look at something like the DWA oil or Nasdaq Detroit oil index, it's has 33 buys in its favor, which seems great, right? Out of 41 RS charts, or I guess 40 RS charts, because you don't compare it against itself. Um, it's on a buy signal versus 33.
Good.
Pretty
Right.
good.
Yeah.
However, in terms of short-term relative strength, it's only in a column of X's versus one other group. So a lot of weakness from a short-term relative strength perspective. And those are the ones that you got to be really careful for, especially if they're at the top of these matrices, because the picture can change really fast, right? So if you didn't pick up oil exposure with the, rise in oil prices and energy stocks doing quite well so far this year, be very cautious with
Yep.
that exposure at this point. Um, there's not a lot of short-term strength to lean on to keep these things from really giving up the long-term battle.
Right. And like you said, I mean, these are the types of areas that you look one day, right? And you are, in seventh place, right? Or you're in fifth place if you're oil services, right? And then the next day or the next week, right? Especially in a volatile group like the energy complex, which is going to move around a lot with news out of the Middle East, right? This is the type of thing where you move from seventh to 16th in a single day, right? Now, I want to preface this. We don't design the matrices to be that volatile, right? Or that receptive. We're not trying to get things to move around extremely quickly, right? We're designed to be long term primarily, but the point here to make is that when you have so little X's, so little near term strength against some of these other areas, that 33 buy signal count that we look at for that oil group, it's just on thin ice, as my mom would say, when back when you're in trouble, right?
Yeah.
So, just be very careful, especially if you picked up exposure to those groups and just watch those positions particularly closely. Conversely, we want to be focusing on those areas that maintain their buys and also maintain their X's, right? So the elephant in the room, semiconductors have been extremely strong this year. Areas, even Nvidia has picked up a little bit, right? But a lot of semiconductors are doing particularly well, right? Electronics have picked up. Telephones on the semiconductor, or excuse me, comm services group has done particularly well. So there's a lot of other areas that you would probably sit there and say, these are stronger sectors and don't carry with them that risk of rolling over in the near term.
Yeah. Hey, exactly right. I couldn't have said it better.
I will ask a question and then we can wrap up here. What do you think about trying for the bottom fishers listening today? What do you say about somebody who's trying to do the exact opposite of what we just did and is looking towards the bottom of the matrix, trying to figure out your sectors that are picking up near-term strength?
Yeah, I mean, that's one where you can get these laggard rallies and they can reverse into a lot of X's, right? But still, like, the buy signal count's really low.
Right.
It is always really intriguing to look at some of these weaker areas and see, like, oh, are they about to enter that turn, right? I would wait for them to probably, if I saw something at the bottom, and was like, okay, that's an interesting area, I would wait until it at least picked up some buy signals and got kind of closer to the mid part of the matrix if I was really trying to
Like
do
a
that.
software group.
Like a software
Okay.
group, precious metals index there at the bottom as well. Um, software is interesting. We talked about that one last week. Ian and I did that, like, IGV charts at a really interesting spot in the mid 70s, kind of long term support. Um, and then we see, like, software group ranked second to last in this matrix, but it does have 17 X's in its favor. Um, Gonna need further improvement before I'm gonna go, okay, well, let's really start to dip our toes into software.
Right.
But it's an area that has my interest, right? Because this is one prior to this year, or even in the last year, long term was one of the best areas to be in the market, right? Um, a lot of fears around the AI narrative and things like that. Market still hasn't given us the green or even yellow light to try to dip our toes in here.
Right.
But we are seeing a little bit of life here.
Right. Yeah, and for context, right, 17 is still under half the matrix,
Yeah.
right? So just keep that in mind. And I think, and then I'll close and give you the final word if you've got one. To further your point on waiting, right? Relative leadership is and sustained relative leadership, the type of leadership we want to be invested in lasts longer than just a flash in the pan. So we get calls from advisors all the time. It's like, I don't want to miss this, right? I don't want to miss it. Well, with real leadership, you won't miss it, right? Even if you miss that move from the bottom to the middle, it can feel like FOMO. It can feel like you're missing out, right? But the point is that these guys that sit at the top of the matrix, they're the ones that you really want to focus on, and ultimately, right, stay up there rather than just trying to catch the move from the bottom to the middle. So keep that in mind when you're looking at your overall positions, and remember, continue to just trim allocation of those areas that are showing you they're losing relative strength. Anything else today, Joseph, before I just keep rambling?
No, I don't think so. I think I think you nailed it on the head, right? I mean, just to wrap up, like semis, for example, that group was in the top, let's just say top 10 from January 2023, pretty much never dropped out of the top half until August of 2024, languished a little bit, and then got back above, in the top 10, later last year. And really, like, that's when we've seen a ton of gains in semis
Right.
from maybe NVIDIA's not carrying the load like it was, but like Microns,
Right.
those
Other
type of
areas.
names.
Yeah.
Yeah.
All right. Well, we're running long. I appreciate everyone's time today, and I hope everyone has a wonderful and safe week. And we will be back again next week to touch on any updates.